In online. My name is Eugene. I'm the founder and CEO of Magnolia Tax Services. Magnolia Tax Services is a tax advisory practice that specializes in tax planning, tax preparation, tax representation, which is a fancy word for we'll represent taxpayers if they get summoned for an examination, which is another fancy word for an audit. And then we also do accounting and bookkeeping as well. I'm also a real estate investor. I've been buying real estate since 2018. Originally from Chicago, born and raised on the South Side. I started doing wholesaling for a while, and then I transitioned into fixing flips, and then I started doing buy and holds. So I started out buying 2-unit buildings, 3-unit buildings, and then in November of 2022, started buying more larger multifamily properties, 24 units and more on the north side of Jefferson Park of Chicago. And I acquired a smaller tax practice in Milwaukee in November of 2022 as well. And I transitioned up a year ago, and I've been here ever since. And Milwaukee's been treating me pretty good. And this is my new home. This is my new home. So today we're going to have a good conversation. We can talk all things tax related, all things LLC related. So if you do have a question about anything in particular, or if there was something that you just wanted to make sure you got out of today, I'd love to answer that question for you. And we'll dive into the meats and bones of this party. So whenever I do presentations, I always call them a party, because when you go to a party, what happens? We have fun, right? We have fun. We leave with memories. The last thing I want you to leave here with is nothing, right? I want you to take as much information from this presentation, from this party, as you can, so you can go out and implement this in your business right away. Have by show of hands, have any of you have ever attended a training or a webinar or anything that was designed to give you new information and you was just like, damn, what do I do? And it wasn't anything concrete that you can implement and do right away? Well, I'm going to give you at least 10 things that you can do right away into your business tomorrow. And if I don't, let me know. I'll count them on the way out if you want me to. But I'm pretty sure we'll give you 10 things you can do. So a quick disclaimer, anything that we talk about today is just general tax information. I highly recommend. Hey man, how you doing? Good. I highly recommend for you to seek advice from a licensed tax professional like myself, where we can dive into your facts and circumstances on a more intimate basis and get a better understanding of where you are as it pertains to your business, if you have rental properties and so forth. Sounds fair enough? Fair enough. Okay. Let's get this party started. So what we're going to talk about today, we're going to talk about the difference between tax planning and tax preparation. A lot of people don't know that there's a big difference between the two. We're also going to talk about what a tax write-off is and what qualifies for a tax write-off or tax deduction for you. Real estate professional tax status. By show of hands, have anybody in here ever heard of real estate professional tax status? Wow. Yeah, there's a tax status just for real estate folks. And I love this tax status, and we want to talk about why this tax status is so important and how you can use it to ultimately keep your tax liability as low as possible so that you have more money to reinvest back into your business so that your business can continue to grow and can continue to scale. We'll talk about entity structure. How should I set my business up? A lot of folks are paying a ton of taxes just because their business is not set up correctly. It's one thing. So we'll talk about entity structurally, bookkeeping, and then we can play the Q&A game for a bit. We do not have to wait to the end of the slides to ask questions. If there's something that comes up and you want to get that question answered, I would love to answer that question for you. It may even take me down a different tangent. I might talk about something that I didn't even plan to talk about today. So if you have a question, feel free to ask right away. So what's the difference between tax planning and tax preparation? Does anybody know? Somebody take a stab at it.
Well, planning is something you're doing ahead of time, and tax preparation is what you're doing at the end.
There you go. Yeah, that's it right there. So tax planning is more of the proactive approach, rather tax preparation is more of the reactive approach. And the average taxpayer, the average person, they start looking for a tax professional around tax filing season. Between January and April, that's when they start thinking, hey, I need to find somebody to file my taxes this year. I want to work with a CPA. I want to work with a licensed enrolled agent. I want to work with somebody that can understand my business if I also understand the tax code? And that's when they start looking. But to be very candid with you guys, they're a little bit too late. You're a little bit too late because we're limited to what we can do for you when it comes to filing your taxes if you're reaching out in April, January, February, or March. Because the only thing that we're doing is we're just recording in the tax return what you did in the prior year. That's it. There are some additional things that we can recommend. Hey, you should max out your Roth IRA. You should max out your traditional. Do you have a health savings account? All these things that we can do last minute to minimize the tax bill, or hey, let's put some money into a SEP IRA. However, if we can plan periodically throughout the year, so that way nothing comes to us by surprise, we essentially have a bigger advantage, right? Anybody in here ever got a bill by surprise? Yeah, it doesn't feel good. You'd be like, what is this? Right? The last thing that we want is a tax bill by surprise, because they will collect one way or another. So you guys understand the key differences between tax planning and tax preparation. Tax planning is more of a proactive approach. Tax preparation is more of a reactive approach. And as agents, you guys know your income fluctuates. All entrepreneurs, our income fluctuates. We may have a big Q1, or we may have a low volume Q1, and things may pick back up in Q2, things may pick back up in Q3. But if we're meeting periodically throughout the year and we have visibility to be able to say, hey, Eugene, I'm anticipating for your tax bill to be $20,000 when we file. What do we need to do? Now we can start answering those questions of what do we need to do between now and December 31st to minimize your tax bill as much as possible. What most accountants, tax accountants, will tell you to do is, hey, we need to make some estimated tax payments. If we're anticipating for your tax bill to be $20,000 and there's 4 quarters in a year, let's make estimated tax payments of $5,000 per quarter. That's our what? That's our what? That's our $20,000 that we're anticipating for us to owe. Well, I think that's a bit lazy. We think that's very lazy, because if we can do something about it, why not? So what our approach is at Magnolia is, hey, let's identify what we think your anticipated tax bill is, but what tax deductions can we give you in the process? How do we minimize that as much as possible? So instead of tying up $20,000 with the Wisconsin Department of Revenue or with the Internal Revenue Service, how can we put that $20,000 back into your business so that you can leverage it for a VA to assist you with making cold calls, or so that you have more time for marketing? How do we put this back into your business so that you can make more money, and then we make estimated tax payments on the remaining? So that's the strength of being involved in some type of tax planning, because you get the visibility there. All right. Write-offs. Anybody here know what a tax write-off is? Well, talk back to me. Don't just listen to me. It's a party. Remember, it's a party.
It's an expense that you can claim to lower your income.
Okay. It's taxable income. It's an expense that you can claim to lower your taxable income. That's one. Who else we got? Come on, we can do this.
Write-off is any product or service that you purchase that's in furtherance of your business.
Any
To
product
your business.
or service that you purchase to help further the business. That's two. Give me one more. My brother in the back, what you thinking?
I was gonna say pretty much that same thing.
Same thing, okay. So code section 162A tells us that a tax write-off is anything ordinary and necessary in the pursuit of income. That's the true definition of a tax write-off. It's anything ordinary and necessary in the pursuit of income. So if you've ever been summoned for an examination, anybody here ever been summoned for an examination? By show of hands? No? Perfect, great. You don't want it. But what happens is a revenue officer gets assigned to your case, and they start going through your deductions. And one of the questions is, hey, why did the taxpayer buy this? What was the significance of you buying this product service? Well, it has to be necessary and ordinary in the pursuit of income. What about this clicker? You think this clicker is tax deductible for me?
Yes.
Yeah.
Why?
I know you said it for your presentation.
I use it for my presentations. This is ordinary and necessary for me in the pursuit of income. This is a tool that I can use and leverage to share information, share education that can highlight my business, highlight the expertise that we offer as a firm. So a tax write-off for you guys may look completely different for a tax write-off for me, because it's all based on the industry. It has to be ordinary and necessary to that specific industry. So these are some of my favorite tax write-offs. Home office. Anybody here has a home office? Everybody in here should have a home office if you don't. Everybody in here should have a home office. It's the best gift that the tax code gave us. One of the best gifts that the tax code gave us. So what designates as a home office? It's a place in your apartment or place in your house that you use regularly and exclusively for business purposes. That's what the tax code says. It's a place that you use regularly and exclusively for business purposes. We all should have that place in our apartment or place in our house where we can go to be innovative. Maybe you guys call old listings that didn't sell. Maybe they are reinterested in selling in the future. But we gotta have that place that we go to where we can get innovative. And that's why home office is important. And they give us two opportunities, two ways to take a home office deduction. They say, hey, Eugene, you can take the simplified method or you can take the actual method. I'm a big fan, big advocate of the simplified method because it's exactly what it sounds like. Simple. And so what they tell us is, hey, we'll give you $5 a square foot up to 300 square feet. That's a $1,500 tax deduction with your name on it. All because you have a place in your home that you use regularly and exclusively for business purposes. Did I say you had to spend $1,500? No. So this is a tax deduction that this is a gift. You didn't have to spend no money at all. And they're going to gift it to you because you have a place that you're using to be innovative. You have a place that you're using to get those contracts out. You have a place that you're using to take those client calls. It's important. So then they say, you know what? How about we give them another method, the actual method? What is the actual method? The actual area method, this gives us the ability to write off a percentage of our expenses. And we record this on the 8829. This goes on the 8829 if you're a Schedule C filer, and or we just put it inside the 1120S if you file as an S corporation. So for number's sake of simplicity, let's say the total square feet of your house is 1,000, okay? But you use 300 square feet for business purposes. What percentage is that? That's 30%. So now I'm taking 30% of my rent. I'm taking 30% of my renter's insurance. I'm taking 30% of my utilities. Same way with the house. We're not writing off mortgage payments. You cannot write off a mortgage payment nowhere in America. But we can write off the mortgage interest. Okay? So which deduction you think is going to give you the bigger deduction? I got one for simple.
Depends.
It depends. It depends. And so these are some of the scenarios. These are the things that we're talking about with our clients. Now, we do have to be very careful. We do have to be very careful if we take the area actual method. They look at it. Because typically the area actual method usually gives the bigger deduction. How did you measure it? How are you paying for these things? One thing that we do once a month is we're always reading IRS publications. I have yet to see an IRS publication of them auditing someone taking the simplified method. but we see it all the time when they take the area actual method. So it's important that we understand what those levers are, right? What are the things that we can do? Just because we can do it don't mean that we should do it, right? So it's important for us to understand it. But everybody in here should have a home office. Who in here has a home office? Everybody in here should have a home office. Okay,
So having a home office doesn't necessarily, I had always heard that it kind of triggers a threat of an audit, or like you have a better chance of getting audited if you claim a home office.
no, that's somebody that was scared to give you a deduction. Yeah. That's somebody that was scared
But
to
what
give
if
you a
it's,
deduction.
what if there's like occasionally a guest stays in said home office? So it's not exclusive.
Occasionally, a guest stays in the home office, so it's not exclusive. Is it exclusive to you? Do you stay in a home office?
No, I mean, if I have a home office, but
Yep.
occasionally,
You answered the question already. You don't stay in a home office.
no,
So you use it
exclusively.
regularly and exclusively for business purposes, right? That's what you use it for. Guests came over, guests stayed the night. I don't think they can prove that a guest came over and a guest stayed the night.
I probably even.
Unless they live in it.
The bed out of IRS agents coming over.
Yeah, it wouldn't be worth their time. They wouldn't do it. It's a great question.
And I have a home office, Stanley.
Yeah, you got a home office. You should, everybody in here should have a home office. Every single person in here should have a home office. It's important that you have it. Yes.
This might seem trivial, but I had a different tax preparer. She was like, well, do you write off? I can understand maybe like clothes for business, but she was like, even like a regular prep. So like the hair, nails, lash, whatever.
Mhm.
pedicures. She was like, yeah, you can write it off. I'm like, interesting, but what are your
Okay.
thoughts?
So that's a great question. So for the people that's tuning in online, the question that's been presented to the floor is, hey, I had a previous tax professional that told me that I can write off hair, nails, and clothing.
Yeah.
So everybody, not everybody, but tax professionals, we interpret the tax code differently. You may talk to me, I may tell you this is my understanding.
Mhm.
You may talk to someone else, they'll tell you that this is our understanding. You may talk to the first person that you get in contact with at the IRS, and they'll tell you that this is their understanding, and then the next person you talk to, they may have a different understanding. So it's differences. It's based on how you interpret it, okay? I would be careful.
Yeah.
I wouldn't do that. Now you can do it if it was for a specific use, specific purpose. Let's say you were getting ready to go have a photo shoot for a listing,
Mhm.
right?
Yeah.
That's for a specific purpose. You having a photo shoot, that type of thing.
Yeah.
But if it's a deduction that you would have benefited from personally anyway, they can make an argument and say, how is this ordinary and necessary in the pursuit of income? So I would be a little bit careful.
It's a very good line.
It's a thin line, unless you just happen to be not only a realtor, but a content creator as well. So you're always posting content online on social media. We can try to find a way to make it make sense. But the best thing to do is to just be very straightforward with what they tell us that. Fine. Well, they give us three ways to take a meal deduction. As long as we discuss business before, during, or after the meal. They give us 3 times. So when you get there, you can talk about business. I love my business so much that I'm always talking about the business. I can't stop talking about the business. I'm not a realtor, but I'm always looking at houses on Zillow, on the MLS. Hey, did you see this? You can't show a client that. You can't show somebody that. Hey, look at this nice kitchen. Business right there. You discussing business. Oh, here's the after repair value. This is what market rent is. Okay? We can get you in here at 5% down with convention. All we have to do is talk about business before, during, or after the meal. When the food comes, talk about business. Or maybe you just forgot. You forgot to talk about it when you got there. The food was so good, you forgot to talk about it while you were eating. Talk about it on the way out. Right? That's the third time. They give us 3 times to talk about business. And anybody remember what happened in 2021? The pandemic, COVID, what else happened? When COVID happened, what happened? Where were you at? Home. You was in the house, right? A lot of our favorite restaurants were closed. They was trying to figure out how to navigate, how to maneuver through this space. What do we do? Ordered in, right? So a lot of our favorite restaurants suffered during that time. The restaurant business suffered during that time. Then they start coming out with PPP loans, economic injury disaster loans. Some people got them that was supposed to get them. Some people got them that wasn't supposed to get them. You know, if you're in the room, I won't tell nobody. But what they did was they made meals 100% tax deductible. In 21 and 22, meals were 100% tax deductible. So when I look at the tax code is nothing but a big incentive plan. Hey, taxpayer, if you do these things, this is the benefit. What you guys need somebody that understands the tax code, that can put it to you, give it to you in simplest terms, so that you understand what you can do, you understand what you can't do. But that's all the tax code is. It's just a big incentive plan. Hey, if you buy real estate, we'll give you a gift called depreciation. Hey, if you buy real estate, we'll give you a gift. You won't pay any Social Security or Medicare tax on it. You only pay federal and state income tax on it. Hey, if you do these things, so you just need somebody in your corner that can just tell you what to do that's applicable for you. So in 2021 and 2022, meals were 100% tax deductible. They said, okay, back to normal. All right, 2023, meals went back to 50%. But I would still rather take the 50% than not take anything at all. Okay? Although, you guys drive a lot. You know, you guys drive a lot. Okay? So there's 2 ways we can take the auto deduction. We can do mileage or we can do actual. I got a few clients right now that picked up a new Ford F-150. We had some fun with that. What am I talking about? So last year, mileage was 65.5 cents per mile. This year, the mileage rate is 67 cents per mile. So if you guys are out there, well, first off, let me back up. How do we take a vehicle deduction? How do we do it? Okay, I gave you 2, but 1, any deduction that we take, we got to always make sure that we track and trace it. Any deduction that we take, we always got to make sure that we track and trace it, period. Whether you take the mileage deduction or you take actual. The code says that you can write off the vehicle as long as that you use that vehicle for more than 50% of the time for business purposes. How do we prove that 50%? Documentation. How do we prove that 50%? Documentation. Document. And that's why it's important, even if you're not taking the mileage deduction, if you're tracking your miles. So if I started the beginning of the year, I started tracking my miles. By December 31st, I drove, let's say, 10,000 miles. Out of those 10,000 miles, I had 5,100 miles that were for business purposes. I used that vehicle for what?
51% of the time.
51% of the time. Whether I decide to take the mileage deduction or not, you still need to have some type of support documentation to be able to show that. And a lot of tax professionals, they forget to tell their clients that. Even if the client is not taking miles, hey, we can take actual expenses, repairs, gas. We can take 100% of the car payments if you're leasing it. But they forget to tell them that regardless, if you take either one, you still got to track your usage. Because if they just so happens to reach out and they say, hey, Eugene, but how? How did you come up with this percentage use? Well, we don't have any documentation because we weren't tracking anything. Okay, it's important. Here's another big dilemma that a lot of people think. They think they can't write off their vehicle if they didn't buy their vehicle in their business name. Nowhere in the code it says that you have to buy your vehicle in the business name. They're just concerned about the use. So you can buy that vehicle in your personal name and still use it for business purposes. Now I want to talk about real estate professional tax status. This is like, I love this tax status. This is one of the things that I want to give all of my clients. All of my clients. I personally, I think this is the best thing to hit the tax code. Best thing to hit the tax code. Real estate professional tax status. Your CPA, your enrolled agent should be talking to you about this. They should be talking to you about this all the time. All the time. So why is it important? What is it? Give you guys a little bit of a foundational story. So some background work first. Every taxpayer in the US gets allotted a $25,000 special allowance that they can take from their real estate to offset any active income. That's W-2 income or income coming in from a business. Everybody in here gets it. Yes.
Is that by household?
By household. Everybody in here gets it. Now, what happens is, once your income goes above 150, then your CPA starts telling you, well, you can't take any of these losses from your rental activities because you make too much. You can only leverage those passive losses to offset other passive income. That's what they tell you. But they don't talk to you about real estate professional tax status. Well, the power and the beauty behind real estate professional tax status is it unleashes, it unlocks, no matter what your income level is, all of those losses from your rental real estate across all of your active income. That's why you see a lot of entrepreneurs, you see a lot of business owners buying real estate. They're buying it for the deduction because they need it. And if you buy right, then you're also going to cash flow as well. One of the beautiful things about real estate is that if you buy right, typically you are positively cash flow, operationally. Okay? But on paper, you have a paper loss. What is the paper loss? Right? Know what I'm talking about?
Depreciation.
Depreciation on the tax return. Because once the depreciation kicks in, it should be wiping out as much of that income as possible. And so we're paying no tax or barely any tax on this income from our rental properties. And then you get the tax benefits. So how do I qualify for real estate professional tax status? And here's another issue. We're actually dealing with this now. Client came over to us from another practice, and she's a realtor, and her person automatically assumed that just because she's a realtor, she's automatically a real estate professional. That was his understanding. Well, we have to understand what makes up a real estate professional. What does the actual code says? And she lost that audit. What does the actual code says? Well, the actual code says, hey, you have to materially participate in that rental activity. Meaning, what does rental activity mean? That means you got to have some rental properties. You have to materially participate in that rental activity for 750 hours or more in a calendar year. And more than 50% of your time has to be spent in that rental activity more than anyone else. She had a property management company. How was 50% or more of her time being spent in that rental activity? Second thing, she didn't document her hours. So they don't know. They don't know if you spent 750 hours or more in that rental activity. But somebody smart, there's always somebody smart behind the scenes plotting. Right? How do we figure this out? 750 hours, that's too many hours, man. You know, I got a day job, I gotta do other things. They said, well, we're gonna introduce this new thing 5-6 years ago called Airbnb, VRBO, Booking.com, where people can come and do a short-term stay. So what I tell you the tax code was?
Interpretation.
It is a individual's interpretation of what the rules are and how those rules are applied. What was the other one? Also start with I. It's an incentive plan. That's what it is. It's an incentive plan. Hey, taxpayer, if you do this, we'll give you this in return. So they came out with Airbnb and they said, hey, we know in order to qualify as a real estate professional now, you have to meet the 750-hour material participation test. But if you do Airbnb in one of those properties, you don't have to qualify and meet the 750-hour test anymore. You only have to meet the 100-hour material participation test. Wow, that sounds a lot better than 750 hours. Would you guys rather have 750 hours to hit or 100 hours? 100 hours all day. And so what happens is once we qualify you as a real estate professional, we start introducing the opportunities for us to do what is known as a cost segregation study. Anybody here familiar with what a cost segregation study is? Accelerated depreciation. Essentially what happens is an engineering company comes out. They now also have DIY cost seg opportunities as well. Well, all you do is set up some photos and they have this algorithm built out in their system and they'll do the cost seg report for you. But essentially what happens is an engineering company comes out and they're looking for everything in that property that has a useful life of 15 years or less. What are they looking at? They're looking at the roof. They're looking at the appliances. They're looking at the cabinets. They're looking at the flooring. And they're accelerating the depreciation on that. Okay? And what we typically see right now is the deduction typically comes out to about 20% of whatever the purchase price is. I'm giving you a selling point if you are a realtor that works with investors. I just gave you a selling point. If your client talks about, hey, I'm always getting hit on taxes, well, you should consider buying a rental property. Or you should consider doing a cost segregation study on this new rental property that we're going to buy, because it will give you a ton of tax benefits. I have clients that just buy properties just so they can get tax benefits, which is not a good reason to buy, by the way. Okay, the first reason to buy is because the numbers make sense on paper, right? That's the first reason, and then the added on benefit is the tax benefits. Is your business structured correctly? This is what I see common for agents all the time. We can have just a little bit over 200 agents in our practice now from brokerages that don't matter because we at KW, right? Brokerages that don't matter. And one of the common themes that I see is their 1099s is getting issued in their name. They don't have business bank accounts. They're using personal credit cards for everything. I have one client that's, hey, I do have an LLC. My 1099 is going to my LLC, but I have a personal credit card that I use for all of my business expenses. Does anybody see a problem with that?
Mhm.
What problem you see, bro?
Validating, and if you get audited.
Yeah. Co-mingling funds. Co-mingling funds. I see this all the time. I say, hey, you got a business credit card? Yeah, I got a business credit card. Oh, who's it with? American Express. Oh, okay. Is it a business name or your name? I gotta start asking that question now. Is it your name or the business name? Or is it my name, but I just use it for business? They don't cut it. Let's not cut it. We have to get it in the business name. So, is your entity structured correctly? One of the biggest mistakes that I see is agents are getting their commissions under their personal name. And it removes the ability for us to get creative with how you're being taxed. So if you are getting your commissions in your personal name, 10 times out of 10, you file what is known as a Schedule C. Anybody in here filing on a Schedule C? Yeah, most people, most agents. Most agents are filing on a Schedule C until they come talk to me or someone like me. And there are some benefits and there are some cons as well. What is a Schedule C? So a Schedule C makes up your 1040. Your 1040 is your tax return. There's a ton of pages in that 1040. There's the 1040, page 1. There's a Schedule 1. There's a Schedule 2, Schedule 3, Schedule B, C, D, E, F. All right, I love Schedule E the best. Anybody know why? Real properties. That's where the real estate show up at. On the Schedule E, on your personal tax return. So generally what we see is small business owners that elect to be taxed as an S corporation generally pay 27% less in taxes than Schedule C filers. I'm also a part of a very large tax practitioner network. I've been a part of this network for a while now, a few years. Very expensive, but very worth it. Because once a month we meet. There's about 10,000 tax practitioners that come on these Zoom calls, and we meet once a month. Okay, we meet once a month, and we look at all the states that are auditing. In 2023, where do you think the Wisconsin Department of Revenue was listed? Let's take a guess. 12, okay. Close, hot, real hot. 15. They were 15 on the list. 15 on the list. This year, in February or March, it was either last month or in February, they went from 15 in 2023. What do you think they're now? I heard 5. Anybody else? Lucky number
7.
7. 7, man. This is serious, you know? And when they look at the folks that are getting audited the most, one, it's people who haven't filed in a while. And then they submit a bunch of tax returns at once. 1. 2, the folks that forgot to report some of their income for whatever reason. Maybe they forgot that they got a 1099 from selling cut and close knives. And 3, individuals that file on a Schedule C. But why do you think this is so? Because the Schedule C is the easiest way to cheat on the tax return. It's the easiest way to cheat on a tax return. Because what a lot of people do, unfortunately, is they leverage the losses from their business to offset their taxable income from other income sources like a day job. And they cheat. And it's so easy to do that because any tax preparer can file a Schedule C. It's a lot harder to file on an 1120S. And 1120Ss are a lot harder for the department to audit. So they don't spend a lot of time with 1120Ss or 1120s or 1065 if you're in business with someone else, but they are looking at Schedule Cs. Another thing that I see all the time is clients trying to deduct what they pay themselves if they are filing as a Schedule C. We call that onus draws. The amount of money that you send from your business account to your personal account, that is a non-tax deductible expense because you have to pay tax on that. And that should be reflected in your net profit. Your net profit is essentially what you paid yourself. That is your income. That is your wages. If you're filing on a Schedule C, I highly encourage you to look at Schedule SE. Pull up that schedule. Pull up the Schedule SE. It's in your tax return 110% of the time. And see how much you're paying in self-employment tax. And just see like, wow, how much I'm tipping. Every time I file, I tip this amount every year. I don't know about you guys, but I like to tip. I'm a tip. I tip my waitress or my waiter. I tip my person at Starbucks. You know, sometimes I just tip the computer. There's nobody even behind the thing. I just tip. You know? But the last thing I want to do is tip those guys. I'd rather donate the money to a church or some other nonprofit organization rather than tipping those guys. Now, I do want to make sure they get their fair share, but I don't want to give them any more than that. Okay, here's a client that came over to us from Vegas. She found us online. Hey, you guys got a bunch of Google reviews. I'd like to check you guys out and learn more about what you do and share my facts and circumstances. Okay, great. What's going on? Oh, well, I got this letter in the mail, and I'm not sure what this letter means. I was wondering if you can help read the letter. Anybody ever seen a letter like this before? This is one of the letters that you get when you've been summoned for an examination. And so if you look at the red arrow here, what are they asking about? Other expenses. And then it says SCHC1. What is that? Schedule C, page 1. Hey, I want to know, what is this you're reporting on your Schedule C? Most artists, unfortunately, Schedule C filers. Here's when I know a rookie tax professional. They could be licensed and still be a rookie. This is one of the things I see often. It's unfortunate, but I see it often. If we see a lot of expenses in the other expense category on your Schedule C, then we know, okay, that person's a rookie. Because they're looking at other expenses. If a client gives me a P&L, and in their P&L, it says miscellaneous, some of y'all probably ain't doing miscellaneous expense, general business expense. The IRS does not know what that is. They do not know what that is. I will send you that P&L back and I will say, hey, let's get on the call. How can we parse out these miscellaneous business expenses, the general business expenses, and put them in an appropriate category? They give us a category to put them in. Let's put them there. Now, that doesn't mean that we can't use the other expense column. We can, but when we use it based on the system. And we don't want no more than 10% of your net profit of items being in other expense category. Okay? Here's another one that we see with the other expense category. They will literally put in the other expense category, other expenses. You can actually write it out what the other expenses are, but they don't because they're lazy and they got so many clients that they're probably trying to get to, and they're just like, let me just get this in here and get them done. You know, very lazy approach. Give you another one. How do I know if I'm working with a tax professional or not? Somebody that's legitimately in the business, even if they're licensed. I have a client with KW, actually. She's not here, but she's coming today. She's with KW. Someone of her family is an attorney. And so we assume that when we have people that have different licenses, that they may have experience in other areas. Okay. Well, how do I know if the person that I'm working with is truly a tax professional or not? I can look, I can check by looking at my tax return. A lot of taxpayers they just hand over the tax return, the taxes to their accountant, and they trust that everything is correct. And they don't even look at the return. They don't even see it. Oh, this is what you owe. Okay, wire it on money. Send it on money. Oh, here's your refund. Give me your direct deposit information so we can have your refund ever out. They don't even look. They don't question, hey, what's this? You should always be curious about everything. Always be curious. But one of the dead giveaways is when you look at the tax return, it actually tells you who prepared the return. So if you went to somebody and you paid somebody to prepare your tax return, but it says self-prepared, that's a dead giveaway. Why does my tax return say self-prepared when you prepared my tax return? We see this all the time. All the time. And with the woman that I'm talking about, the attorney prepared the return, but it says self-prepared on there. So if it says self-prepared on the return, who's liable for the return? You're 100% liable for the return. 100% liable for the return. Now, you're still reliable for the return, even if somebody else named it on there or not. I don't know if a lot of folks know that, but that's your tax return. The CPA, the enrolled agent, the tax professionals don't get the letter. Who gets the letter? You. You get the letter. But however, there is some responsibility there on their end as well. Okay. So she's getting audited, was getting audited for other expenses. Here's a client that came over to us, doing very well. She was doing very, very well in her business. And she went to someone at Liberty Tax. When she first went to them, she didn't owe anything, nothing. She was actually getting a refund for $500. Trust me, this woman does not get a refund. Okay, she does not get a refund. But at that time, you know, they're probably celebrating. They probably went to the bars and got some shots or something. You know, hey, you got a $500 refund. Here you go. And she goes to the lender because she had made a promise to her kids that she was buying a house this year. Single parent mom. She goes to the lender. The lender's like, hey, Eugene, unfortunately, but you're not making any money. You know, I can't lend you anything. She goes crazy. What do you mean I'm not making any money? I mean, X, Y, Z. So she goes back to the person at Liberty Tax to fix it. And the person at Liberty Tax fixes it. And now she had a tax bill for $44,000. Okay. She owed $37,000 to the IRS, and she owed $7,400 to the Wisconsin Department of Revenue. She's like, how do I do this? Right? That's the down payment money for the house that I was trying to get. I could get on an installment agreement with them, but then I got to pay them over time. And then if I get on an installment agreement with them, now this factors into my debt to income ratio. The lender's still looking at that. So what happens? So thankfully, she said in one of my presentations, I don't know why it took her 6 months to reach out to me, but it took her 6 months to reach out to me. And she reached out and we saved over $22,000. But just doing one simple thing. The only thing that we did, we could have did a lot more, but we got to understand when there's a time to be aggressive, when there's a time not to be aggressive. And one of the things that they look at is amended tax returns. Do you ever want to increase your risk of being audited, amend a tax return? So we amended the tax return and we backdated her entity to be taxed as an S corporation. Just by changing her from a Schedule C filer to an S corporation, saved her over $22,000. Yes.
So I get the whole like being an LLC or like like going from just being a what's the word? Like we as realtors.
Independent contractor.
Yeah, that. Okay, I understand getting the LLC because like say something happens in the business, whatever, like the liabilities on the business, not you.
Yeah.
Now, the difference between an LLC and S corp, I was told, and I'm asking for your correction, that for an S corp you have to make a certain amount in order to file as such, and then it comes like different, that it's taxed differently, like a different bracket and stuff. Could you give more information on the differences and if you have to qualify, stuff like that?
Yeah, that's a great question. the moment you create the entity, you can be taxed as an S corporation. There is no, oh, you need to make this amount of money before you can do it. You can do it right away. If you project that this year I am going to kill it. Okay, my first year as an agent, but I've been watching the game for a while. My aunt is a realtor, my husband, spouse, whoever is a realtor, but I've been learning. Okay, I know how to generate leads. I know how to generate new business. Right? That's a very important skill that a lot of people don't know that how important that is in business. The ability to be able to generate leads. Okay, to be able to have a funnel and get people in that funnel. Okay, and overload that funnel as much as possible. And now we start building teams out underneath us. Right? Because I got so much business coming in that I can't handle it all. But I can train and I can buy more time by bringing in more people. So the question is, hey, can I be an S corp right away? Do I have to meet an income limit? So let's understand what the S corp is. Let's understand what entities are. Okay, so you can be an LLC, taxed as an S corporation, or you can be a C corp, taxed as an S corporation. The S corp is nothing more, nothing less but a tax election. That's it. We're waving to the IRS and we're saying, hey, tax me this way now. My entity is not changing, but my tax status is changing. I'm a man, and I mail in a letter, or I fax over a letter to the IRS and say, hey, I'm a man, but I want you to tax me as married, filing jointly, because I'm not single anymore, I'm married, right? That's essentially what the S corp is. It's a tax status.
So
It's
like
not
a
an entity.
Okay.
It is not an entity. A lot of people get that confused. It is not an entity. It's just a tax status. Did that help?
Yeah.
Second part to your question. Do I need to be at a certain income to be able to do it? The answer is no. However, I don't recommend for a taxpayer or for a business to be taxed as an S corporation until they have a minimum of $30,000 in net profit. A minimum of $30,000 in net profit. That's when I would recommend for us to convert you over to an S corp. Okay? Because with the S corp comes new responsibilities. Right? Yes, it's going to save you money in your taxes, but it comes with new responsibilities. And one of those new responsibilities is that you now have to run a W-2 payroll for yourself. That's known as reasonable compensation. Because you still have to pay some form of Social Security and Medicare tax. One of the biggest issues, one of the biggest reasons why some tax practitioners will say, hey, no, don't move over to the S corp. Don't do that, is because what happens is when individuals do transition to the S corp, they don't run any payroll. And now you essentially, that's considered tax evasion if you're not running any payroll. Because when you're filing on the Schedule C, you're automatically paying your self-employment tax on your net profit. When you convert over to the S corp, you only pay self-employment tax on what you run a W-2 payroll for. So if you don't run any W-2 payroll, you're not paying no Social Security or Medicare tax or no unemployment. You're not paying anything because you're not running any W-2 payroll. You following where that's going? So we have to run a W-2 payroll when we convert over to the S corp. The beautiful thing about converting over to the S corp, though, is you only pay self-employment tax on what you run a W-2 payroll for, not on my entire net earnings, how I was filing as a Schedule C filer. You follow that? So we have a system. It's all about a system. We have a system that says, hey, you should run a payroll for this amount, because we don't want your payroll to be too high. That would almost negate the reason of us converting you over. And we don't want your payroll to be too low because it has to be reasonable. There has to be a reasonable compensation. So we work with you to get you what is that reasonable compensation? What is that? And I pay my fair share of self-employment tax on that number, but not my net. So if I have a net profit of 100,000, right? But I run a payroll, let's say for 30,000. Now I can deduct what I pay myself through the business versus Schedule C via the owner draw. I cannot deduct what I pay myself. So let's say my net profit was technically 130,000. I run a W-2 payroll for 30,000. I can deduct it from my net profit. What's my net profit now? 100. I only paid self-employment tax on the 30,000, but I did not pay it on the 100. You follow what I'm saying? But you still pay federal income tax and state income tax on the 100. Let's not forget about that one. Any questions on that? Okay, that's the first step. That's the tip of the iceberg. That's why we want to have an entity, right? That's why we do not want the commissions to be coming to our personal name. Because one, we want to make sure that we have some type of, we want to minimize our liability first off, okay? So we create a limited liability company. I'm a big fan of LLCs. I am not a fan of C corporations. I am, but with a certain strategy. Okay, so one of the things that we're talking about with our clients is, hey, what do your medical expenses look like? Why are we asking these questions? Because we know that you cannot deduct any medical expenses that's beneath 7.5% of your adjusted gross income. So you have to hit that 7.5% threshold first to be able to take any of those medical expenses. So if we do bring on a taxpayer, we do bring on a client that does have significant medical expenses, then we would entertain the idea of them opening up a C Corp for a specific purpose, okay? And what that C Corp allows us to do is establish a healthcare reimbursement arrangement, an HRA. It's just like, that's a whole nother concept. But we can pay for those medical expenses and we can deduct it via friends benefits. So we're no longer subject to the 7.5% anymore because we have a healthcare reimbursement arrangement, an HRA. Now, it's important for us to have good bookkeeping. How am I on time?
We're good. If you want to be respectful of others.
Yes.
If you need to bounce, feel free. What do you think? Another 5 or 10 minutes?
Yes.
I think we're still good.
Okay. Sorry, I talk too much, right?
It's a lot to cover.
It's good.
All right. So do you have proper bookkeeping? This is so important, so important, so important. If we're going to do all these things that I'm telling you to do, you have to do these things as well. Okay. It's not, hey, set the LLC up, fill out this 2553 form so I can be taxed as an S corp, tax it over, start running payroll, pay my reasonable comp. I'm good. Thank you. No. Okay. There are a new set of responsibilities when you're actively running and operating a business. And I have a saying that says, whatever you don't track and trace will go away. Whatever you don't track and trace will go away. You have to follow the money. You have to follow where the money is going. That's why it's very important for us to have some form of bookkeeping. I recommend QuickBooks. QuickBooks is the #1 accounting software in the accounting industry. And one of the beautiful things I like about QuickBooks is you can train it. You can feed it information. You can give it rules. Hey, when I go to Capitol Grill, what's your favorite restaurant to go to?
Oh, gosh. Eddie Martini's
Eddie Martini's. Where's the Eddie Martini's at?
in Tosa.
I'm going in tonight. Eddie Martini's. When I go to Eddie Martini's, it automatically knows this is meal, okay? Because I only take my clients here, right? It's a nice place.
Oh, yeah.
Oh yeah, I gotta go.
You do. Go right at 4:30, sit at the bar. You'll be taken.
It's a good time. So if you can feed, if you can train a system to be able to do things for you on your behalf, it's going to save you a lot of time. I get so many clients, new clients. This is only the new ones. And this is a part of the curve. I get so many new clients. Hey, I'm here to file my taxes. Here's my 1099s. Here's whatever. And I'm like, where's your P&L? P&L, what's that? Where's your profit and loss statement? What's the profit and loss? The profit and loss shows the income that came into the business or businesses, and the expenditures, the expenses over a period of time. From January 1st to December 31st of 2023. Where is that document? Oh, I don't have it. Okay, well, here's what I can do for you. One, I'll give you a template that you can use so that you can attempt to do it yourself. Okay? I love this strategy, by the way. If you ever want to upsell somebody on accounting, this is what we do. Say, hey, I'm going to give you this template, and you can fill it out yourself. Guess what they do? Okay, well, how do I fill it out? Here's what you do. Go through all of your bank statements and use these categories on this template and put everything in these categories. Go through all the bank statements. For your credit card and for your debit card. Put everything in there. What do you think happens? 2 weeks. Hey man, I can't do this, man. This is too much. I get some clients that got the time, they can do it. You know, but it's important that you have some type of P&L. You have, because I'm going to need that. Your tax professional is going to need that to file the tax return. Well, I always go to somebody and that person just does it for me. He just does it for me automatically. I've been going to the same person for 10 years and they just do it for me. Well, we won't do it. Okay? Because it's important that you have control, that you have ownership. Or you can hire us to do it. So a lot of clients use QuickBooks. Okay? QuickBooks can be a bit advanced. So some clients say, hey, look, I'm tech friendly, but this is a bit much for me. Do you have any other alternatives? Yes, Xero. A lot of people are moving to Xero. A lot. Wave. I think Wave is maybe one of the most user-friendly ones out there. It's so easy, simple. Wave is a good one. Keeper. You can also use Keeper. Or you can also use a template, an Excel template that will give you complimentary. And the Excel template works just as fine. If you old school, it works just as fine as you using QuickBooks. All you have to do is make sure you be disciplined with it. And you set an hour time date with yourself once a month on a Saturday or a Sunday or whatever day you want. And you just go through your bank statement for the month. You only have to do it 12 times a year. Or you can do it every quarter. And now you only have to do it 4 times a year. And as long as you have something in place so that you can track and trace how the business is performing, we're good. Any questions on that? All right, here's where things get a bit interesting. So the S Corp is the tip of the iceberg. A lot of people I speak to, I'm already an S Corp. The S Corp is the tip of the iceberg. That's just the first step. Okay. There's a lot of other things that we can do now that we're an S Corp. A lot of things that we can do. Anybody in here have kids? Josh, how old are your kids?
9, 7, and 4.
9 and 7 and 4. Wow, we can do some cool things with the 9-year-old and 7-year-old. We can do some real cool things. Anybody else in here have kids under 18?
Yeah, mine are 15 and 12.
Oh man, we could really have some fun. So one of the things that, and this is not on the slide, but one of the things that we talk about, and you can do this strategy if they're not your kids. Okay? But I'll tell you how to do it though, when we talk one-on-one. But you can do this strategy with your kids. One of the things that we talk about is, hey, you should start a family management company. Okay? You should have a family management company. Because with the S Corp, there's a whole new set of rules. Okay, with paying people. It's different. But you should start a family management company. It's a separate LLC. We can call it Josh's Family Management Company. Okay? Josh, you married?
Yeah.
Beautiful. Okay. What's your spouse's name?
Jamie.
Jamie. Okay. So I say, hey, Josh, let's start a family management company, and we're going to make Jamie the member manager of that company. She's the owner of that company. We're not going to put you nowhere on the company. It's just Jamie. But we can still call it Josh's family management company. So what happens is, if your kids are under 18, you can pay them up. I'm giving you the technical. You can pay them up to the state standard deduction. There's some states that follow the federal standard deduction, and there's some states that have their own thing. And so there's a lot of information. I see people talking about doing this, but they don't really give you all of the details, because if you truly want to make sure it's tax-free, we want to make sure that we follow not just federal, but we also follow state as well. So I say, hey, Josh, let's get this family management company going. And we can pay the kids through the family management company. Well, why do I need to start this family management company and I already got the S Corp? I can just pay them through the S Corp. Well, the S Corp has rules. If we pay them through the S Corp, now we got a W-2. Okay, we don't want to issue a W-2. And what happens is, a lot of clients forget that if they are going to pay them through the S Corp and issue a W-2, to make sure that you don't withhold FICA. You do not need to withhold FICA. So to get rid of that altogether, we create a family management company. I can send $13,850 a year per kid to this family management company. Whatever we don't track and trace will go away. Anything that we deduct, we always have supporting documentation to be able to support it, right? Okay. So what's the supporting documentation here? Hey, Josh, this is what we're going to do. We're going to 1099 Jamie. We're going to 1099 that family management company to show the $13,850 that went over. And now what does Jamie do? She pays the kids. She pays the kids. Now the kids have accounts. You can still be on the account, but now she pays the kids. Because guess what? The kids are still going to need what? Clothes. They're still going to need food. They have expenses too. School trips, school field trips. Versus you just paying it regularly, you ain't not getting nothing for it. But if we shift it this way, for the things that you were already going to pay for anyway, we now get something back, which is what?
Tax-free.
A tax deduction. So this is one of the strategies that we talk about all the time. Hey, how do we hire our kids in our business? That kid can do what? Marketing and advertising. I got a niece that's 7 years old. She know how to work Instagram, like everything. I'm like, wow. Crazy. I didn't know how to do that when I was 7 years old. I think I was still playing Nintendo, maybe. So here's what we set up. Here's what we create for you. And this is known as, we call it the trifecta. And what we do is we divide your life in half and we say, hey, all of your active income we're going to put on the left side. All of your passive income, your assets, we're going to put on the right side. Okay. And anybody here has rental properties? Okay. So if you have assets, you should have some form of a transfer on death instrument. You should have some form of a transfer on death instrument, not just a will. Okay? You should have a trust. So what we say is, hey, let's establish a revocable living trust. Okay. And your revocable living trust is the member manager of all of your entities. Okay. One of the biggest issues I see with real estate folks is they say, hey, yeah, I got an entity in Wyoming. Anybody know about these Wyoming entities? Ever seen some of the social media and stuff about it? So they always say, hey, create your LLC in Wyoming or Delaware so that you can get anonymity. So people don't know who you are. You can hide your name. You can do all these things. And so they create the Wyoming LLC, and then they register that Wyoming LLC as foreign in Wisconsin or foreign in Illinois, and you lose all of your anonymity because you have to register that business with the Secretary of State or with the Wisconsin Department of Financial Institute. And now they can see who owns the business. Okay. But if I have a Wisconsin entity, we'll call it Wisconsin LLC 1, but that Wisconsin LLC 1 is owned by Wyoming LLC 1. When they look up who owns rental property at this address, they find out that it's Wisconsin 1 LLC. Okay, who owns Wisconsin 1 LLC? I like to cold call them. Maybe they'll wholesale or they'll sell a deal to me and I can wholesale it. You guys own rental properties. You've got a call before if somebody's trying to buy your property from you, right? But then they see that it's owned by another entity where they can't go to the Wyoming Secretary of State to see who owns that asset. Okay. So these are some of the things that we talk about. These are some of the things that we encourage. Hey, are you maxing out your IRA? Do you have a solo 401k? A lot of folks don't know what a solo 401k is. Do you have a health savings account? Are we maxing these things out? One of the best deductions that we can take or that we can get is a deduction that'll fund your future. So this will take you directly to my calendar. If you guys are interested in having a one-on-one conversation where we can understand your facts and circumstances a bit more intimately, or you can give us a call. Okay? You can also give us a call. And what I love about Magnolia is the energy. Okay, it's a culture thing. It's energy. KW has a lot of energy. A lot of energy. It's like motivating to come into the office sometimes. Man, I just want to be around the energy so I can soak it up. Right? You ever have a bad day? Just go into the office. If you're having a bad day, go into the office. I promise you, you'll leave out more energized than you came in, and you're ready to get back in it. So you can give us a call. Our front office is going to say, "Hey, it's a great day at Magnolia Tax Services. How can we help you smile today? Full of energy, ready to roll, ready to go." If you have any questions, I'll take them at this time. No, we went over. Yes.
Is there a timeline for setting up the entity for a specific tax year? Like if we currently, everything's coming to our personal and we want to set up an LLC, can we take advantage of it for the tax year of 2024?
Yes, because we're still in 2024.
Okay.
So you can create the LLC today. Okay, you would need to update your W-9 with KW. And hey, here's my updated W-9. You keep your social security number as far as away as possible from that document. And you put your name in box 1, put the business name in box 2, and then you put your EIN number on it. Done. Any other questions? All right.
Thank you.
Yeah,
Thank
good.
you. Thank you.